I think the market is treating this sector incredibly rationally. In that second and third wave of upgrades we've seen from basically everyone, we haven't really seen share prices really respond at all. In fact, they've kind of trended downwards, to be honest. So we've seen two very strong recent bellwethers in JB Hi-Fi and Super Retail Group provide incredibly strong trading updates with 30 to 40% kind of consensus upgrades, and the stocks again went slightly down. So I think, as I've said before, the strong will get stronger. I think when things do eventually normalise, and it will take time, I think they will normalise at a discernibly higher level than FY19, because I think, they are in a better position than pre-COVID now from a range of initiatives such as balance sheets and a bit of cost out initiatives, etc. But there is one clear thing, that the current earnings trajectory is not sustainable. As I've said before, putting through divisional margins we've never, ever seen before. Our fundamental view is that we would not be as overweight the space as this time last year. That's already playing out in the market, as you can see. The other thing, though, because the market is being quite rational with the space, when we do ultimately see that normalisation of demand, perhaps we won't see as an aggressive pullback in some of this space. The key test, and I think the market probably won't do much with this space, is going to be the fourth quarter of this financial year, when we do cycle some incredibly strong comps, and to see how we fare through that process. I would say a lot of these companies have held their cost bases very lean, because they're concerned about the inevitable too. So that'll be a key kind of question point for these companies. This just displays a little bit what we were talking about then. From the 2nd of Feb last year to the 9th of November, there was about a 20% hike in EPS forecasts, and share prices lifted around 18%, so not dissimilar. Then from the day before the vaccine was announced to yesterday, we've seen another 23% lift in EPS, and share prices up about 4%. So clearly market not willing to bake in that last stage of earnings lift. Look, you guys well and truly know all about the macro stance out there. There's a lot of tailwinds. The tailwinds are actually in excess of the headwinds, interestingly, at this point of time. I'll let you run through all those. The tricky thing at the moment is we've seen such a never-seen-before kind of situation where we've got demand through the roof as that redirection of spends occurred. We also have these softening of the blow kind of, thematics around, FX, strong housing market. It's near impossible, though, to work out how important they are in softening that eventual demand normalisation. And I think anyone's kind of guessing at this point, and that's why the market's not really believing FY22 forecasts. But a big positive for these companies is, and how do you value this, the excess cash generation that's occurred over the last year, even setting aside JobKeeper, because there should be a higher value ascribed to these companies having net cash balance sheets across the board. So plenty of very strong tailwinds out there, and consumer household balance sheets in very good position. People have saved more and they've spent well, so in a net benefit positive position. The headwinds, obviously, that eventual normalisation, margins just simply aren't sustainable where they are at the moment. Those cost bases are quite lean, and maybe some of those companies won't get cost bases quite back to where they were, but then again, we want to see companies invest to protect themselves in the future. We've got that fading stimulus and also that obvious pull forward of demand, more importantly, in some categories more than others. These are just a couple of slides to run through. These are the extent of the FY21 upgrades to our forecast we've made since February last year, so pre-COVID. So, pretty astronomical. National Tyre obviously had an acquisition as well, but, Moto is 140%, Beacon 80%, Super's 80%. So some big upgrades. Again, 22, not as big as FY21, because we're forecasting that does normalise a bit, but quite significant. Most importantly is probably this slide, which shows you where our current 22 forecasts sit to where versus what they actually achieved in FY19. So about a 3-year kind of, a 2-year kind of implied growth, setting aside 1 year was, an anomaly. And still there's some very big growth in there. So despite us having earnings falling in FY22, if you compare back to 19, the last kind of normal year, there's some big growth in there, and that's going to be a big question for the market, should that be achieved. AP Eagers, big cost out in there, probably set that aside. National Tyre, a big acquisition. Adairs has had a big acquisition in there too, but still some fundamentally big numbers. Share price performance, that's very similar to what we've seen in terms of the extent of the upgrades. Maybe like a Beacon's probably outperformed the upgrades. Baby Bunting, we haven't really had to move our forecast through the whole thing, so hasn't over-earned at all, that business, so looking quite well placed. Most of our companies, as you would have seen with the flurry of reports from me and James, have guided. There's a few who haven't. Baby Bunting, IDP, Domino's and The Reject Shop. Everyone else has provided very recent guidance, so not much to update the market on. It'll all be about the trading update, but the trading update should, let's face it, be very similar to the recent trading momentum we've seen, so that won't surprise the market at all. I suspect very few, if any, will give FY22 guidance. That's fine, and I think all the questioning and interest is going to be around cost bases and the extent to which companies are willing to invest some of those FX gains back into price and protecting them and being category leaders in the future. There's a bit of a screen there of where we're probably most comfortable at the moment. You know, we say we'd be de-weighting the space, but we've always got plenty of ideas, which is interesting because we do cover a lot of niche retailers. But we've spoken a lot about a few of these, so James and I are just going to focus on 4 big liquid kind of names this morning. So I'm going to start with Domino's Pizza, which I think always gets put in the too expensive category. I actually think the company and its model is better placed than it has been in about the last 3 to 5 years. And the basis to that is when you have a healthy network of profitable franchisees who are making more money, and they're making more money. That gets the whole engine going. They're more willing to roll out stores, and let's face it, about 80% of this company's growth comes from a big global rollout, and that's really stalled over the last couple of years. We've had franchise inquiries domestically, and a couple of these territories, the franchisees haven't been making as much money. They've been pretty flat, and therefore store growth's pretty well stalled. We know from their website they opened about 130 stores in the first half. That's a record by some margin for the group. Yes, they would have had some, delays from second half 20 with COVID. They're cycling an incredibly weak margin period in the second half. So while sales were pretty robust through COVID, they stepped in and supported their franchisees the way a big company should from a corporate governance perspective when they run a franchise business and they have a few territories in a bit of trouble in some regions. And that gave them some pretty heavy OPEX deleverage. So that should massively reverse in the second half. Japan and Germany absolutely on fire and growing. The one interesting thing will be that Japan has been a 1 purchase a year, 2 purchase a year kind of market, around Christmas and birthdays because they're quite expensive. If COVID has driven a bit of step change in that to more frequent purchasing by individuals, that could mark a bit of turning point for that business and for the group. And also Australia has long been considered a very mature market. If we get some upside there, I think the market could get quite excited, and this could be about a 15 to 20% kind of compounder for the next couple of years. What do you pay for that? Is 40 times the right price? I mean, it's in the eye of the beholder a little bit. It's certainly at a premium to its peers, as we can kind of see there. But it's in control of its destiny a bit more with the growth, and its growth is certainly at a premium to its parent and its peers. So you can just see on that slide too, that's that big step up in the store rollout in the last half, and should that continue, that's a big driver of the group's business. So one last thing on Domino's, I think, when you get consumer or ConsD analysts in the market who are going to come out of this being a bit worried about how, enduring some of this demand can be, I think they'll look at a business like this and say, well, it wasn't really a big beneficiary. We can see the growth drivers, and this is a big global stock, so I think it might keep a fair few people interested. Moving on to Lovisa, look, you guys know this and very well held across our network, but look, it's the one stock I cover where, it's been brutalised by COVID, but I genuinely believe it emerges in a far better position. So when we loved it pre-COVID, we should probably be loving it more now. Similar to sectors like travel, we don't really care about this result. A lot was out of sight of its control with various regions going into lockdowns. And it's really interesting they haven't come out and said anything about their result, because I genuinely expected, it's not going to be pretty and they'd have to kind of warn on it. But I think maybe that means that they've probably controlled costs in those territories where stores have been required to close better than perhaps the market expects, and therefore that would dampen the earnings blow a bit. But look, at their last update, they told us comps where stores were actually open were tracking at about negative 10%. I would expect since then, with Australia genuinely kind of emerging from any kind of real lockdown that we've seen this country really burst for them in terms of their comps. So to the extent they do give a trading update, this stock will only trade by appointment to that update, where they can see where a normal result kind of comes from, and I would hope that they can point to some robust trading conditions in that market. The next stage of outperformance for me kind of comes from that, push forward of the rollout. So getting that rollout going again. I don't think we'll get that discernibly this half. We've still got countries that aren't even trading. They're still trying to deal with landlords. So don't expect them to be massively pushing the button just yet. That said, they did that incredibly attractive Beeline acquisition a couple of months ago, which was extraordinarily in their favour, and that takes the pressure off of them to have to roll out stores, because it added 20% footprint growth to this business. I think we forget that. That got them into about 6 or 7 new European countries, and 20% to their footprint. So if you look at this business now versus FY19, we've got 40% more stores on the ground. That's quite powerful. But we have, putting that into context, our FY22 EBIT forecast is about 20% above, or 27%, sorry, above FY19, but store footprint should be about 40%. So on the flip side, when we come back out of this, hopefully our forecasts and consensus prove to be too conservative. So a genuine stock that looks better placed. Just, a lot about this. This shows the global spread of the business now. It is genuinely global. This is pre-Beeline, so that will expand even further. This is their presence now, really broad spread across the United States. So I just looked yesterday, they've got 63 stores now in the US. So they did put 15 on the ground in the first half despite COVID, which is pleasing. That's in line with our full year forecast, so they've banked that already. That's great. But having said that, UK and France are both pretty flat, so that the momentum there has stalled. Not unexpected. And there's just a reminder there of the Beeline acquisition and all the countries it introduced them to. But over to James on IDP Education.
Thanks, Joe. Yeah, just on IDP Education, just a bit of a reminder, the two key divisions for this business are they do English proficiency tests, and they're for university students, and secondly, the placement of international students into university. So this, as you can see on that chart, has been a genuine compounder. It's got a unique business model, which they founded 50 years ago, and pretty limited competition globally. So given its focus on international students at the moment, obviously it has been impacted by COVID. So I guess what gets us excited on this one looking forward, firstly, there is significant pent-up demand for both divisions. It's English testing and the student placement. We think it's not as discretionary as some of the travel companies, because students do want to get on with their education goals. And as a result, we think this can bounce back quicker than the market thinks in FY22 and FY23. Secondly, we think there's a significant M&A price on offer here. So the English testing side of the business, they operate in conjunction with an entity which is part of the British Council. They're basically competing to deliver the same test in each particular region. Now, British Council over the last couple of months has had some financial difficulty given obviously COVID, and they're seeking sort of debt at the moment for it. So we think there's the potential, I guess, material synergy price plus market share gains to be had should some sort of deal eventuate on that side. So similar to the travel companies, in terms of the first half result, all the sort of headline numbers will be down significantly. However, we think that commentary around, I guess, pent-up demand in the system and, I guess, a quicker than expected bounce back as students start online and look to come later in the year to different regions could, I guess, see upside to consensus forecasts for this year. And then if you sort of look at that chart on the slide there, thinking about sort of, in the COVID period, obviously consensus forecasts went down quite materially. They're still not sort of where they were pre-COVID, despite there's about 50,000 students still waiting on the sideline from last year to, I guess, get placed and do their English test. So obviously it's never easy to buy this one. It does trade on a big multiple now. It is in the ASX 100. I guess we think that COVID provides an opportunity, I guess, for a big earnings catch-up and growth on the other side. So we're happy with that one.
So just look, we can't go through every stock, and everyone does have their favourites, and we talk about them all a lot. So we just wanted to talk about 4, interesting, more exit kind of plays this morning. But a few tidbits there for you to read. Look, quickly, Adairs, we think there's more in M&A coming, which excites me and could be a nice little accretive deal to plug a hole. Uni, again, tiny, but we think it's a genuine compounder. Eagers, still a lot of earnings drivers there, but, it's had a big run. A lot of the consensus upgrades now have run through. If you wanted to trim a few, I wouldn't be completely against that, but genuinely feel like that's still got some pretty good levers, and volumes are still well below the And Peak. Beacon, probably the most correlated I covered to housing. So if you really want that play, that's for you. Balance sheets, net cash, they're doing some good property deals, and I may underestimate their ability to really execute in the US in time. So, a reasonably well placed, good place to be. And then James's Atomos, which he's talked about more recently.